Welcome to our Emerging Leaders Tech Series. I'm Caroline Seibel, Director with PwC Germany's Deals Tax Practice. Today, I'm speaking with Winnie Tang, PwC's US Pillar 2 Specialist in the financial services industry. Winnie, thank you for joining us today for our very first Emerging Leaders Tech Series.
Happy to be here with you today, Caroline.
Winnie, the international tax landscape is evolving as new regulations are emerging. We see change happening at the foundational level because of the Organization for Economic Cooperation and Development, also known as OECD's Pillar 2 project. Pillar 2 today is the main hot topic for multinational enterprises. Can you tell us about Pillar 2 and why it's so important to tax professionals around the world?
Pillar 2, or the global minimum tax of 15%, is really around the corner with the effective date as early as January 1st, 2024. So for calendar year end taxpayers, companies or the funds already need to make disclosures in the 2023 financial statements if there would be material Pillar 2 impact for 2024. So it's really time to do the analysis and make sure the operational system is ready to do the calculations, and or see if there are any exclusions rules that could be applicable for structure to be outside of the scope of Pillar 2. For the in-scope structure, though, it is often very difficult to see if the effective tax rate of certain jurisdiction would be below the 15% tax rate without running a model. So for example, we continue to see a lot of US companies with statutory rate of 25% having an effective rate that falls below the 15% because of both the R&D credits, which are not Pillar 2 qualifying credits, or the FDII regime, which is the foreign-derived intangible income regime in the US. So you really can't just look at the statutory rates of the jurisdiction, but really running an ETR analysis is really the only way to do it properly. And that's especially because since deferred taxes can only be measured at a 15% tax rate, so the overall effective tax rates are often already dragged down by the deferred taxes to a lower starting point, although mathematically you can't go below 15% just by having deferred taxes. But any permanent differences, such as R&D credits or other incentive, could really cause the effective tax rate to be below 15% and causing a top-up tax exposure in some cases. There is a CBCR transitional safe harbor rule that can ease some of the burden in the next few years, but those are not permanent solutions.
So there's definitely a lot of unpack here. Pillar 2's global adoption is complex with new laws and compliance obligations. Organizations will need a network of international tax experts to ensure the companies are Pillar 2 compliant. Winnie, can you discuss how Pillar 2 can affect private equities and investment funds?
Yeah, so Pillar 2 really applies to accounting consolidations that are above the Euro 750 million revenue threshold, which is measured 2 out of the 4 preceding years. The definition of revenue is not very clear for clients in this space, and that seems to capture unrealized capital gains when counting toward the 750 million revenue threshold. And that's simply because of revenue definition under the CBCR rules includes unrealized gains under OECD guidance. So for example, investment fund with an AUM, let's say of 10 billion, may have 10% of unrealized gains. And so therefore, the revenue could already exceed the 1 billion or exceed the 750 million threshold. So funds are meeting that threshold easier than some may realize.
So you mentioned excluded entities. Can you tell us a bit more?
There are some excluded entity rules that can exclude certain nonprofit organizations, pension funds, real estate investment funds, or just regular investment fund from being in scope of Pillar 2. A lot of taxpayers in this space are working through the exclusion rules to see if they can reduce the compliance burden by simply being out of scope. The documentation of the application of the excluded entities rules would be very important, and certainly we would all expect auditors to be asking for the documentation as early as 2023 financial year, because I mentioned earlier that there would be disclosure already required later this year.
So it certainly appears that accounting consolidation is in the spotlight given the Pillar 2 requirements. Can you explain why valuation modeling has reached a level of increased importance?
For private equity and asset managers, Pillar 2 is really affecting the way that we approach deal modeling. So for example, sellers typically want buyers to pay for step-up, and seller would typically use a statutory tax rate to model the step-up. However, and we all know at this point that when we do the step-up modeling, the model would need to take into account of the top-up tax calculation. So for example, some of the tax basis step-up on certain transactions, for example, buying a US LLC, that the depreciation amortization may not be good for Pillar 2 purposes when we compute the ETR. And that's because there are some rules about depreciation amortization not being deductible when computing the denominator, i.e. the global income. So the denominator would be inflated, so to speak, and diluting the effective tax rate. So in that case, the buyer should not be paying the statutory rate and therefore not using the statutory rate to compute a step-up. And also just running analysis for portfolio companies that are in scope, over the 750 million revenue threshold. I should also mention that there's some traps within worry maybe on some of the add-on transactions. The rules tells you that you have to add back the add-on target revenue in the prior 4 years period, even if the target obviously wasn't owned at the time. So for example, if you have a portfolio company with euro 650 million revenue now, this year, or maybe the last few years, and the target has, let's say, euro 200 million revenue, the rules tells you that you have to add back the 200 million for every single year in the last 4 years. So what that means is that some of the portfolio company, when they do the add-on structure, they might meet this 2 out of 4 years threshold earlier than they expect because of this rule here.
So many important points there, Winnie. Thank you. Entities that fall under Pillar 2 rules, such as investment funds, must realize the impact Pillar 2 will have on their organizations to avoid unexpected and several outcomes. In your opinion, how will these rules impact strategy and operations going forward?
Groups within the scope of Pillar 2 will really need to evaluate and model the impact across the organization. That would include assessing the additional data and reporting compliance requirements, evaluating the existing technology ecosystem and the capabilities, establishing processes and controls, those that they may not have exist right now in the system, upskilling, right, make sure training the tax department is key, and also managing the stakeholders' expectations, like such as the deal team, for example. So Pillar 2 could really have a severe impact on the tax department, the end-to-end operations. Tax functions really need the data to do the forecast and the model for the financial statement purposes, and ultimately for reporting and compliance purposes.
And through your understanding of Pillar 2, Winnie, are there things that tax professionals could watch out for as they enter into this new tax landscape?
Yeah, given the complexity of the new reporting requirements and uncertainty around all these different countries coming out with the new rules, or finalizing the rules later this year, Pillar 2 really is very important for the professionals who really understand this new requirements that's been introduced, which is really enormous burden, right, to the tax department, which are typically already understaffed, especially with portfolio companies. So the way the organization is set up from a data technology perspective, the processes, and that can be very different than how they're run now. So, and this is where the PwC global team of tax experts can really help.
Thank you. There are so many things to take into account when it comes to Pillar 2. Winnie, are there next steps you recommend to finance and tax professionals so they can prepare for when Pillar 2 goes into effect?
The details are in the data. So Pillar 2, very much complexity in the tax data readiness, the tax provision preparation, and financial and tax reporting. So what is really clear is that all the data requirements really forcing private equity funds and asset managers to evaluate the data system, assessing the data resources. So what we can really help is, for example, our PwC data input catalog is really the core of the Pillar 2 readiness. Our end-to-end process is the foundation to develop a extensive data strategy. And so those are key elements to consider. Also, a Pillar 2 engine can really help clients to run the model.
Thank you for sharing insights with us today, Jenny.
Yeah, happy to be here.
And thank you for being here to learn more about how PwC work to stay ahead of your evolving tax needs. Please visit our website.